Government and Regulatory Affairs at Global Digital Finance, which is an industry association that looks to promote the adoption and acceleration of best practices for digital assets globally. I've got a fantastic panel with me here today. I'll pass over to them to introduce themselves, starting with Jennifer.
Yeah, thank you. Hi, everyone. My name is Jennifer O'Rourke, and I work at DTCC, a central securities depository in the United States, where I sit in our innovation, strategy, and design organization. We look at emergent technologies and see how we can experiment and then deploy them for our current products and services and potentially some new ones.
All right, great. Thanks. Pleasure to be here. Thank you. Eric Mitzel, Head of Growth with Intain. And what is Intain? Intain, we operate two blockchain platforms, one primarily for the administration of structured finance transactions, in which we bring in the intermediaries to process the data more efficiently. And the second is a marketplace in which we lay out the infrastructure for digital issuance and investment of these types of securitizations.
My name is Adrian Fritz. I work for 21 Shares. We're based in Switzerland, and we are an ETF, ETP issuer for digital assets. So, yeah.
Super. Thank you very much. Well, I'm really happy with the title of this discussion today, Bridging TradFi and DeFi. Because a lot of the time when we have this discussion, there's always an adversarial approach. It's will one displace the other, and can the two survive together? But this is actually, I think, where we are, which is, how do we bridge the two, that convergence? So I'm looking forward to hearing what the discussion has for us today. But where I wanted to start off, and Jennifer, I'll come to you first. Mm-hmm. Why is DeFi such a disruptor, and what role does it have to play?
Mm-hmm. Yeah, DeFi is an incredible disruptor depending on how you view it. So I think what's tricky about DeFi is how we actually define what it is and what it is not. The way that we look at DeFi is on a spectrum. And you can look at one end of the spectrum as having DAOs and other types of automatic and solutions that are really removing the way that traditional finance has interacted with financial instruments. The other side of the spectrum is one where you take the capabilities that some of these innovative DeFi products have enabled, and you pull out these capabilities and you actually apply them to traditional finance. So if these are the ends of the spectrum, there's a lot of room in between. And at DTCC, we've been really thoughtful about how we can, sitting on the latter side of the spectrum, pull out some of the capabilities that make a lot of sense and provide efficiencies to financial markets and apply them in a regulated environment. And we can talk more about some of the particular exploration we're doing. But I think to just come back to the question you asked quite explicitly, what is going to be disruptive or not is quite simply the way that traditional finance applies these novel concepts that sit in DeFi. And there's going to be a lot of opportunity to do it in such a way where we can actually immediately bring benefits to our clients right now without giving them the risk exposure that sits on that other end of the DeFi spectrum.
Absolutely. And Eric, I'll come to you.
Sure.
From a structured finance perspective, what are the benefits that this comes in? You said one part of your company looking at structured finance.
Yeah.
How does it fit?
No, thanks for the question, softball. It's what we do. So how does it integrate DeFi, right? So the process within structured finance is mired in a lot of data transfer. And for those that might be familiar with that process, Europe's a little different than the US, but point is you take a pool of loans. Those originated off-chain, we'll use that context here. But those loans are done and underwritten by banks, which is what they're good at doing. But once those loans roll into a pool, it goes through a warehouse facility. That warehouse facility has to revalidate that data. That data is coming through an Excel file and a PDF file. And so then modeling begins to structure that deal, all done in some sort of Excel modeling tool. You could use Tableau or some other software, but point is you're modeling that data again. That data then comes into the next phase of the process of securitization, into the servicer role, in which is going to be responsible for collecting those repayments on those assets that are pooled for that investment. long-winded answer. Point is, once you get into the securitization part, which is the investor purchases, you've had so many touch points and exchange of data that sometimes things are lost. It's ambiguous, and blockchain solves that problem of data transfer. And we can talk about the immutability of that audit trail, but just process improvement. That's in a shared ecosystem, which is kind of what we've tried to develop. We're inviting the participants, all of those that I've named, the underwriters, the servicers, the warehouse facilities, the paying agent or trustee, all into the same ecosystem so that you're sharing that same version of truth. You're operating off of the same data stream. And so you can kind of eliminate a lot of the duplicative costs, which would be just kind of validation and reconciliation of data. And so it's boring, but that's really how we've tackled blockchain at first and applying it to traditional finance.
Absolutely. Well, one of the things that you said there was the multiple touch points that we have to go through. And whilst the use case for DeFi here is, removing those touch points, making it quicker, faster, cheaper, more efficient, those touch points are also quite important from and serve an important role in this. So, but how do we bridge that effectively?
Yeah, you're correct. So from a regulatory standpoint, I think that's probably the largest headwind I think that faced traditional finance at first, which was DeFi and blockchain. This was kind of a headwind hurdle. How do we get past this disruptive technology? And somewhat to Jennifer's point, it's kind of self-assessment. You have to decide as an institution whether or not you want to participate in the way that the markets are moving, or be a stalwart and say, this is not for us. And I think there's some things that each camp can learn from the other. And I think it's that point of integration. And so if we can, somebody once said to me that everyone in capital markets, we're talking about investment bankers specifically, don't think the process is broken. And the only way that they're going to make the change is if you can demonstrate that it's cheaper and faster. And that this is where some of the benefits of DeFi come into play. But you need to have the integration of the participants in order to make the market.
Yeah, absolutely. And then the other point that you brought up there about the immutability aspect of this. Well, I think that's also a really important point, because an important aspect of DeFi, an important aspect of the current traditional financial construct is that there are those touch points where you can kind of reverse transactions. There are those touch points at which you can then where there could be a dispute and there is some sort of arbitration process. How do we deal with that in DeFi? And that's I appreciate I'm bombarding you with questions here, but please, Jennifer and Adrian, please jump in as well.
Yeah, no, I think you're raising an important point. So essentially, it's important to draw this out specifically. When we think about automated solutions, we are imagining the happy path. But the reality is that there are a variety of circumstances where these edge cases that will not hit the happy path will find themselves in, our institutions, and we will have to resolve that. So how do we do that today? At DTCC, whenever a transaction comes into our organization, if for some reason it doesn't go STP or there is some kind of break in it, we obviously have manual intervention through our operations team that can resolve this. If you draw that example and try and now to place that in DeFi, you have to imagine a solution that is absolutely so perfect that there will never be an edge case that needs to be remunerated. And that is very difficult to imagine. So with that in mind, it gives pause to the idea that there could be a fully autonomous solution that would not require any type of manual intervention, that would not require any type of adjudication and resolution. With that in mind, I think that, again, this pulls us back to the spectrum where we can look at degrees of automation and we can see there's incredible benefits with these degrees of automation. Should we work to provide those efficiencies to traditional markets? Absolutely, because those efficiencies will further relate to cost savings and time savings and resource savings. So those are some of the benefits that we pull out from DeFi. But the idea of removing governance from a administrative quality to a fully automated, code-based solution just seems unwieldy to get right from the start and consistently. And so I think that is a practical consideration that we should all have in mind as we think about what is that space in the spectrum where DeFi capabilities make sense, or perhaps even a broader DeFi solution is a best fit. But we have to recognize that there still are some shortcomings to that and some benefits of having an operations team and manual intervention to resolve those type of issues if and when they occur.
Adrian.
No, maybe I want to add on your very first point why I think DeFi is so disruptive. I think it's just it really is financial innovation. The creation of money, and I think this new generation of the internet is really like about how we transfer value. Someone on the panel said it earlier that Web 2.0 did the same thing for information. I can FaceTime anybody on this planet if they have signal, talk to them for hours, and it's for free. Like 20, 30 years, that was not possible. You had like a massive phone bill. The same is happening now, or hopefully happening to money, which is nothing else than an information system, in my opinion. And I think DeFi is really good at like revealing all those inefficiencies of the traditional financial markets. What I love about this, everybody's included. Like in the past, when we talk about money in general, there was only a limited amount of people that had the responsibility to work on how to create money. But now basically, actually every teenager in his pajama out of his bedroom could start programming the new reserve currency. In theory, but that's basically where DeFi comes in place. Really, this financial inclusion, efficiency, speed, and I love to see it. But obviously, we have to make that bridge to traditional finance as well.
Yeah, well, absolutely. You say that, but I think one of the big stumbling points for DeFi at the moment, and I think importantly, this bridging aspect of this is UI UX, right? You look at a lot of DeFi at the moment, and frankly, it's impregnable for the average citizen. So surely that's one of the things that we've really got to address here for it to be that anyone can go ahead and have access to finance, access to these products.
I totally agree. I think there's a lot of challenges if we just look at DeFi, and you're totally right. UX, UI is one of the biggest. I think an average user, they don't really care what they're dealing with. They don't want to, I don't know, install MetaMask, then add a new network, then change the network. It's so complicated for an average user. So the UI, the UX is really not sexy at all at the moment. And I think if we want to gain mainstream adoption, that's one of the key things we have to work on. I agree. You want to add something?
No, you're right on. I mean, I think coming back to some other things that were said on panels today, I mean, there's different asset classes as well, and I think we need some clear understanding about that. And so, if I'm a 13-year-old at home and I want to purchase some Ethereum, I connect to MetaMask. It's easy to do in that sense. But if I want to deploy that capital to something else, now connecting that into the existing financial markets becomes more of a challenge. Yeah. And I think maybe because I'm coming from a TradFi background, but banking these wallets would be an effective use, right? If you could start to see regulation allow for a bank to add that to its suite of products, where now, okay, I'm going to self-custody. That solves our custody problem, which was something that was concerned amongst the public. How do you hold a security token? Again, that should be considered a separate asset, perhaps than Bitcoin or Ethereum or some of the other cryptocurrencies. But as a bank, you're going to want to attract depositors. You want to grow your customer base, and so somehow integrating that process, right? As I say, banking their wallets would be an interesting deployment of that new capital. So we'll see where that goes. But that kind of integration point for us is years out, perhaps. Right now we're focused on institutions and how do we get the institutions to do it. And that's another problem, which is how do they hold a multi-sig credentialed wallet in order to make an investment in some sort of structured product internally at an investment bank or at a hedge fund, right? There's a protocol, there's an investment policy that you have to follow, and so that we have to kind of educate and train and get them to understand how to do it. But once you show them how to do it, that's another point of pause, and they say, well, this is not as easy as I thought it was, even though it's been promised as this very easy method in which you can enter financial systems, right? And so I think there's some partnerships that could be formed in which some of the trusted entities, become the custodian of record, and therefore you don't need to hold the wallet directly.
Yeah, absolutely. And I think one of the other inhibitors that came to mind as you talked about that is the resilience of the protocols and their ability to, from a privacy perspective, but also from a potential to be hacked perspective. This is something that we've got to overcome for there to be institutional adoption. We've got to be able to satisfy institutional adopters that the protocols that they're going to be using are safe to use. As you rightly say, it's a heavily regulated industry, and therefore we've got to mitigate risk there.
And the reality is that, it's kind of easy to lean on regulations to say we have to do this because it is simply required, right? But I think especially in the context of DeFi, it's really important to drill down and ask why, right? So why do we have these issues around privacy, and why are those issues? And when I say privacy, I want to be clear. I mean privacy, but also the inverse of that is identity, right? So why do we need to have clarification around identity attributes within DeFi solutions? And it's not because the regulators tell us to do so. It's not because we, have concerns about, or not even a concern. It's not because there's some interest in, aggregating all of the beneficial owner information. It's because that when there are issues of sanctions, and OFAC needs to get involved to ensure that participants who are not allowed to participate in the financial market don't do so. All of the institutions that could enable that participation are going to be at risk to, lose their standing in the regulatory environment. And those have real consequences, because we want to be thinking about how we can enable identity and appropriately ensure the right degree of privacy and compliance. And I find it really interesting that although, we can speak from an institutional perspective about why these are important and just roll through the regulatory component, recently, in the past few months, we had Jack Dorsey and Vitaly both speaking about this need for incorporating digital identity into DeFi. And in particular, calling this need Web 5. The aggregation of Web 2 and Web 3 with a digital identity component is now the next phase, Web 5. So I think it's important to come back to the spectrum again and say, regardless of what side you sit on the spectrum, we have thought leadership on both sides that are emphasizing the need for appropriate identity and the right balance of privacy protections in this space. The solution that has been talked about throughout the spectrum is one of self-sovereign identity. And it's very interesting because this particular solution that is DLT enabled does allow selective disclosure of particular identity attributes. And so we're seeing the DLT solution landscape evolve to such a way that we can start taking solutions with the technology and applying them to problems that we're facing with other areas of the technology. And so although we do face this privacy and identity push and pull right now, I think it's going to be very interesting to see the way that the solutions develop, and I see a lot of promise around that development right now.
No, I would agree. I think just in general, if we look at the current state of both worlds coming together, I think we all agree that DeFi reveals all the inefficiencies, but at the same time, we have traditional finance that has a long track record, that has gone through a lot of busts and had a lot of learnings. And obviously, there's a lot of good from TradFi as well. So as you said earlier, we need to take the best of both worlds, basically, to quote Hannah Montana.
That's great.
what I want to say in terms of adoption, I think we see more and more coming together. I mean, there's good news across the board. We see Paxos working together with MasterCard. We see BNY Mellon, implementing crypto services and custody. We saw Swift working together with Chainlink. So they want to use CCIP, so a cross-chain interoperability protocol, just to connect both worlds basically and leverage Swift's global network. So, and also at 21 Shares, I mean, we doing the bridge between both worlds by basically wrapping digital assets in a financial regulated product and list them on stock exchanges. It's very easy, and it attracts a lot of institutional clients, I would say. So going forward, if we look at the landscape right now, there's a lot of adoption, there's a lot of interest, and I think going forward, both will come closer together. I know we're in the dark place right now in terms of markets, but I think the future looks quite bright.
Yeah. And I think it's more just an early place, you know, as you start that experimentation, like, isn't it always just a bit dark, a bit, you know, ambiguous?
Yeah.
And I think these are the early days where we're figuring out what the boundaries are and what, again, can we pull from DeFi and put into TradFi, vice versa. When do we start bumping up against hard boundaries that, you know, these things are just going to be non-starters? You know, aspects around security are going to be a non-starter for institutional investment. Like, it's not going to happen. We need solutions that can be very clear about not running into the risks of the hacking instances that we so frequently have and will continue to see. And so as DeFi goes through this maturization moment, I think it's going to be a really it's just going to present itself as opportunities for us to continue pulling out certain capabilities and in real time adding those into TradFi, so that this bridge that we actually are building right now and very much in process just starts to get closer and closer from both sides until this bit of regulatory clarity, which we do indeed need. We certainly need this, is what's going to close that. But I see this as a work in progress. And I see movement coming from both sides that are actually going to bring us, I think, to an appropriate level of, you know, innovative assets and new rails to support them, with the securing and backing of financial, you know, market infrastructure that allows for risk mitigation, consumer protections, smart security around key exchange, et cetera. And there's definitely going to be a lot more to come, but it certainly is early days, and it's a little tricky right now where we are.
I'm conscious of time. I think we might have just about enough time for this. But when we look at this as an infrastructure project, we look at this as trying to essentially move from, yes, bridging the two worlds, but we're also looking at creating a system where we're able to change the fundamental processes and the technology behind how we're operating financial services, and that's a big project to have. And often where we land there is, you know, in a very basic sense. I remember when we were moving our document management system, it took so much time to do, and we were at one point having to save documents in two different folders so that we can shift over. Now, what I'm thinking about here is, one, how do we go about transferring that? But two, where are we on the spectrum, or when it comes into that moving from one system to another?
I'll just say that, having done that as well, it's an undertaking, but it should never be the impediment as to why you move forward, right? Sometimes in those decisions, somebody higher up in the corporation said, "Look, we're making this change," and you go along with it, right? After some assessment of technologies. But in this case, the need to move to, say, a centralized blockchain, and by centralized in that, I mean a shared system. There's different protocols, and we can talk about interoperability and how to connect that. That's another problem that needs to be solved. But when we're talking about deal parties on any financing, structured finance or debt financing or equity financing, if we're sharing the same pipe, then we're connected to the same information. And that part then should be easier to go forward. Then let's grandfather in the things that happened before, perhaps, right? And so I think that's an easier path to adoption, which is say, this is the mark in the sand, and we start from here forward, and everything else is legacy. And that's an okay approach, right? And then you can move the participants a little bit forward faster, I think.
Yeah. The way that we're looking at this is through optionality, and it's a slightly different dynamic than where exactly to draw the line for the new technology as opposed to the traditional infrastructure. But what we recognize is that we have a diverse client base, and we need to serve the needs of all of our clients in the industry. So there are going to be market participants that are fluent in distributed ledger technology solutions, and they will be prepared and knowledgeable, and more than that, they're going to be excited to be able to participate in our solutions and join our networks. And then we're also going to have another segment of clients that are not going to be as familiar or as resourced to access the technology that they would need to have on their side to interact with some of these solutions. And we can't present a new product or service that carves one or either of these segments out. We must always approach our solution design from the perspective that we're going to provide optionality, so that whether you are entering our solutions through traditional on-ramps or through new, novel, distributed ledger technology-based ones, you will be able to access the solutions that you need to. And so we really are leading with an optionality first design approach. And I think that has served us well as we've, like I said, brought in components of DeFi into the work that we're doing with ION for providing accelerated settlement, and the work that we're exploring on central bank digital currency with Lithium. These are areas where we're able to take these things, or take these components from DeFi, bring them in and research them, experiment on them, and in doing so, design out the solutions that make sure that when we do deploy them, we can serve all of our clients. But that absolutely requires that optionality first.
I would totally agree on that. Like at 21 Shares, optionality is the most important thing, how we want to serve our customers. So actually, we have a parent company, which is called 21.co. And under 21.co, we have several sub-brands, basically. 21 Shares is where we have regulated financial products, crypto ETFs, ETPs, and it's the big brand. It's like over 1 billion asset under management. It's quite established. This one is 21 Shares. On the other side, we also have Amoon, and on the Amoon side, we're actually a token provider. What we're trying to do is really think about ETFs, ETPs, or just baskets and indexes, but living on a blockchain. Because we think at one point all financial products will live on the blockchain. And here we really trying to serve those customers that are looking for an on-chain native solution. Because when someone wakes up and wants to buy, I don't know, let's say Bitcoin or Ethereum, they don't think I wake up and I want to buy an ETP or an ETF. They think about, I want to buy Bitcoin. And we want to provide them the optionalities and the easiest way to access them, however they want to like it. Obviously, a retail might go via MetaMask, while an institutional investor might do it through a traditional venue like an ETF.
Absolutely. Well, unfortunately, it looks like we're out of time here, but I'm sure the panelists will be happy to take any questions if you have any in the break. But all I can do is say thank you very much for Jennifer, Eric, Adrian for joining me on the panel today. And
Thank you.
Yes, thank
welcome
you.
to the new panel. Thank you.